Hello and welcome back, guys. In this particular session, what we will be discussing about is IAS 28. Okay, so it's about associate, and then let's look at the basic example first of all, and then we will gradually move on. Okay, so in case of associate, what we need to be aware about is that. So, what is associate? You might say. So, it is an entity over which the investor has significant influence. Okay, and what is significant influence again? Significant influence is the power to participate in financial and operating policy decisions of the investee, but is not control or joint control over those policies. Okay, so it is assumed that a significant influence is there when it can participate in financial and operating policies. Okay, so normally the shareholdings is 20 to 50%. Okay, so in this method we use equity accounting. Okay, so equity accounting should not also be used if the investment is classified as held for sale as per IFRS 5, and then if the parent itself is exempted from having to prepare any consolidated accounts, or it is itself is a wholly owned subsidiary, then you don't need to prepare associates or equity accounting method. You don't need to use it. Okay, so let's look at this particular problem and then we'll definitely get some idea. So let's make our standard. So I'll just show you the question as well so that it'll be easier for you. So example one, associate in CSFP. So below are the financial statements of three companies. So non-current assets is been given, and then after that what we've been given as well is the current assets, equity, liabilities, and then our additional information has also been given. So we need to prepare consolidated statements of financial position. Okay, so let's zoom in a bit, and then so Dipsy acquired its shares in La 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 on 1st Jan 20x9 when La 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 had a retained loss of 56,000. Okay, so how much is the shareholding pattern is that we are not given that information over here, as you can see. So we need to find out how much is our percentage holding or group structure. Okay, so that could be found out from this, from your net assets, non-current assets. So you'll have investment in La La La, and then po is your let's see how much will be the holding percentage, and then based on that we can make whether we can make the decision whether it is a subsidiary or associate. So in this case, let's working note one, and then after that group structure, and then parent in case of La La La. So parent NCI in case of O. So in case of parent, let's look at the figures. So it is 672,000 shares, right? Out of how much? How much is its share capital? We'll find out from this particular, from equity part, right? So its share capital is 840, right? So we can just divide that particular figure by that. So 672,000 divided by 840,000. So this is figures in thousand that they have given. So I'm gonna just write that. So that's 80%. NCI would be 20%, right? After that, or what you could do is that you could do the same thing. 840 minus 840,000 minus 672,000. It's the parents holding, and then you divide that with 840,000. So that should give us the holding percentage of thingy NCI. And then in case of PO, so what we need to remember is that so FO's holding percentage would be 168,000 numbers of shares, right? Yeah, that's what it is. 168,000 out of how much? Out of 560. So 168 out of 560. 168 out of 560. So 168 out of 560. So that is 30%, right? In case of 4, that's the holding percentage, okay? So let's look at working note 2, which will be net assets of la la la. So since this is our subsidiary, this will be our so I'll just unmerge this cell. So la la la. In case of la la la, what's our share capital? Share cap, and then at acquisition, at reporting, at acquisition date it was 40,000, right? And then it's the same figure for this period as well. So and then in case of retained earning, what does the question say? So in case of retained earning, the question clearly mentions over here is that Dipsy acquired its shares in Lalala on 1st Jan 20x9 when Lalala had a retained loss of 56,000. So minus 56,000. So that retained earning has improved and then it has gone to 602,000. Okay, so 56 and 602. So 56,000, which is minus, and then after that the other figure being 602,000, right? And then after that, do we have any other things like in adjustments such as like any fair value adjustments, excess depreciation? So this Dipsy acquired its shares in 4, had a retained earning of this, okay, so that's not really necessary right now. So, and then an impairment test at the year end shows that goodwill for Lalala remains unimpaired, but the investment in 4 has been impaired by 2800. So, subsidiary is not impaired, associate is impaired. And then non-controlling interest is 160,000. Okay, so what we shall do is that, so let's prepare a similar thing for associate as well so that it'll be easier for us later on. Okay, so in this case it is 4, right? And then in case of share capital, what's the share capital? Share cap is 560, right? And then retained earning was 140. 560 and 140. 140,000, right? And then it has improved to 448. 448,000, right? So this is 560,000, just 10, and then let's total it up, because since we don't have any other fair value adjustment, so we can just sum it up. Did the same for the other thing as well. And then now let's move on to working note 3. So this would be calculation of goodwill. Let's merge this cell up so that it just looks good. So how do we calculate goodwill? So we first of all, cost of investment, and then fair value of non-controlling interest, and then after that you add this thing up and then you subtract less net assets at acquisition, which is the value that we calculated in working note 2. So I'll just merge this thing as well. And then what's our merge this thing as well, and then goodwill. So what's our investment? Let's look at the figures. So the investment figures is over here. Okay, so it's in NCA. Sometimes it is given in the in this thing as well, in this additional information as well, but sometimes we need to look it up in investments in non-current assets. Okay, so 644,000 is our investment, right? So 644 is our investment. 644 is our investment. NCI, it is given in this over here, 160,000. Let's add this thing up. Some of this thing, and then after that our net assets is this figure that we have calculated. It is at acquisition. So what we need to do is that subtract this minus this. All right, so that should give us our goodwill. Okay, so this is our total goodwill. And then what we need to calculate next is that working note 4. Working note 4 is calculation of NCI, non-controlling interest. So how do we calculate non-controlling interest? Fair value of NCI and then share of post-acquisition profit. So share of post-acquisition profit, and then after that just merge this cell up and then just looks good. So this is the figure that I have received from over here. Okay, so 160,000, same value, because that is already the value of NCI, and then they will also be getting a chunk from this, from post acquisition profit. Okay, so what we need to do is that this is our net assets at reporting date minus what was the net assets at acquisition. It was this figure into their percentage, so their owning percentage. So how much percentage do they own? 20%, right? So multiply that figure, will give this figure. Okay, so this will be our total NCI, or I'll just write total and then add this thing up. So next would be our calculation of reserves, group reserves. Okay, calculation of group reserves. So how do we calculate group reserves? First of all, we take 100% of parent's income. Parent, right? So how much has the parent earned? Let's see over here. So it's parents retained earning, this figure 1232. 1232. That's in thousands. So I'm just writing it in thousands. Just merge this cell up, and then after that, what will the parent be getting is that they will also be getting share of post acquisition profit. In share of post acquisition profit will always be in, or you could say subsidiary as well. Okay, so that will be more good, like if you say it's a subsidiary, or you could say post acquisition profit. What you could say is that la la la. So I'm just writing LA only, just to denote that it's a subsidiary. And then this will be same as we did in NCI, because they will also be getting a share of their percentage of profit, right? So their percentage is 80%, so they will be getting 526400. Yeah, okay. And then after that they will also be getting a share of post acquisition profit, or post acquisition return earning, you could say, in 4, which is associate. Okay, so what I will do is just put this thing below, and then I'll just merge these two cell up so that it looks better. So what I can do is text wrapping, share of post acquisition profit in subsidiary. Okay, so I'll just merge these two cell up as well, and then text wrap it, and then share of associate, right? So it's better to write down the percentage term as well, and then at the rate 80%, right? Yes, and then in case of associate, at the rate 30%. So how much will they be getting is that, so how much was the profit percentage? We have not calculated it yet. Okay, so what we'll do is that we will make a working note 6 down below. Working note 6, this will be investment in associate. Okay, so how will we, the standard pro forma is cost, and then after that who is that post acquisition profit, or share of profit, you could say share of profit. And then after that, what you would do is that if there is any PURP, you would less PURP, less depreciation, less impairment. Okay, so in this particular case we know the cost because it's already in our here in our NCA. So 224,000, right? And then share of profit is, the question clearly mentions down below, or does it? It does not say how much the profit has been earned, so we have already determined how much is the profit, so which is this figure at reporting date in case of O minus its net assets at acquisition date, right? So that's the post acquisition profit, right? Whatever they have earned after being acquired is already included within this figure of 504,000. So they had a profit earned of 434,000, right? So out of this, how much will the parent be getting is their share of percentage, right? How much share they are holding, they will get that much claim towards the profit, right? So they are getting 130,200. Okay, so since the PURP is not there because associate is not the seller, and then excess depreciation, no, nothing has been overvalued, or like nothing had a carrying amount less than its fair value, so that's not given, so it's always zero in this case, otherwise it would have been different. So in case of impairment, how much has been the impairment? The question clearly says over here that impairment has not, a impairment test at the year end shows goodwill for La 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 remains unimpaired, but the investment in info has been impaired by 2800. So let's deduct 2800. 2800. Okay, so let's total it up. Total it up and then 44. So this is our net investment. Okay, just merge this cell up as well. So what's our share of post acquisition profit is this figure, right? So we have already calculated that as well, and then we need to deduct this figure as well because is impairment that has taken place in our holding, right? So we need to show that particular figure as well. Okay, so I'm just adding everything up. So yeah, that's pretty much it, I guess. A share of profit has been done, and then after that impairment also has been done, and then after that our share of investment has also been done. So let's prepare the consolidated financial statement. Okay, consolidated SOFP. That's what we are asked by question, right? Isn't it? Let's check it out. Yep, consolidated statement of financial position for the year ended December. So that's what we are being asked. So let's prepare that, and then non-current assets. Current assets. What do we have under non-current assets? Let's look in the question. So PPE is 1120 and 980, not the associates one. We don't consolidate that. Okay, 1120 980, 1120 980, 1180 plus 980. Okay, that's what we'll be consolidating. So before that, what I will do is that Control V, and then yeah, see how you get, how we can forget easily goodwill. That's the most important thing. So goodwill is property, plant and equipment. So I think the goodwill hasn't been impaired, and we have already calculated in number 3. So 20,000 is our goodwill. So this is also in figures in thousand. So 1 2 3. So that's pretty much it. We don't have anything else, I guess. Yep, that's it. So investment in la la la, we don't write it down, and then after that investment in four, we need to write that thing down. So subsidiary, we don't write it. So in case of this, investment in associate would be over here as well. Investment in associate. So the figure total is this 351 400. So let's add this thing up as well. Sum, and then after that what we have in current assets. Inventory, current assets. In case of current assets, what we have is inventory. Okay. So merge this thing up as well, and then what are the figures? 380, 640. 380, 640. Okay, so what else do we have? So what we have is receivable 190, 310. 190, 310. 190,000 plus 310,000. And then in case of, what did we have? Bank 35 and 58. 35 and 58. 35,000 plus 58,000, right? So what's our total? Oops. Put that sign. So okay, that's done as well. So I guess our thing is done. So total current assets. Current assets. And then this is total non-current assets, and then our total assets would be current assets plus total non-current assets. Okay, so let's look at equity as well. So I think this figure is good. Let's check this thing out again one more time. See, that's why the numbers are looking so different. So I guess now it's all solved. Yep. That's why otherwise, like, the investment in associate was very small figure. And then in case of equity, what we are given is that ordinary shares. So how much is our ordinary shares? 1120. 1120. retained earnings. So retained earnings. So this is, so what I will do is, in this case, I'll write down which working note did we get this thing from. So 6, and then in case of goodwill, we got it from working note 3. That's our standard pro forma. So in case of work group retained earning, we got it from working note 5. Right. So let's link this figure up. So that's the figure, and then that should give us our total equity, I guess. So yeah, that should give us. So oh yes, we need to put NCI as well. So NCI, non-controlling interest, is working note 4. So what's our figure? That's our figure, and then let's add it up. Average, average man, some. That's done, and then liability as well. Liability. Let's merge this thing up. Bold, just to make it look nice. So what's our liability? So trade payables and taxation. Okay. So trade payables and taxation. Trade payables. So what's our figure for trade payables? 150, 480. 150, 480. 480,000, right? In case of taxation, what's our figure? 9166. 9166, right? So let's add this thing up as well. So how would be, so is total liability, total equity. And total liability as well. Oh shit, I've already added it up. Control X, Control V, and then total assets would be this figure, total liability plus total equity. So this is total equity plus liability. And liability, let's say that liability. So did the figures match? Yep, it did match, I guess. Bold, bold as well. Okay, so this figure matched with this figure. So this is basically how you solve in case of IAS 28 equity accounting. So basically everything is same. All you need to remember is that the investment in associate part. So or you need to create one more workings for your investment in associate. Okay, so what you would do is you would put your cost and then your share of profit, and then that would be decreased by any PURPs if the associate is the seller, and then if there has been any revaluations that might decrease your net investment. So depreciation could do that, and then after that, so what else, that is because the depreciation might increase your, or it might decrease your the depreciation is increased, but your excess your depreciation will actually go up. Okay, so in case of impairment as well, the impairment might be due to different reasons when the recoverable amount is less than its carrying amount. Okay, so this is basically how you calculate your investment in associate. So in SOFP you show it like that, and then after that, in case of SOPL as well. So there is another thing that we need to be worried about, is that in case of SOPL, we need to show it a bit differently. We look at that sort of problem as well. So then don't forget your goodwill. Then after that, basically your retained earning and NCI is most important. Otherwise, everything else is just adding it up. Simple logic. So yeah, if you have any other questions, please do comment down below, guys, and then I'll definitely answer it for you. So until next time, bye bye.